Wall Street whiplash continues. Ross Mayfield of Baird, what is fueling the bounce back in U.S. stocks today?
Yeah, whether you want to call it a relief rally or an oversold bounce, you're bound to get these even amid big bouts of weakness. I think there's a little bit of relief that it seems like the administration is not going to push to fire Fed Chair Powell right away. So a little bit of a bounce on that. But what we're really looking for is evidence that can sustain a longer bounce, a longer rally, and really turn this back into a bull market. And we don't have much evidence of that yet. So oversold bounce, nice to see it. Nice to see a good day, but hard to say it's anything more than that.
Ross, the International Monetary Fund today cut its U.S. and global growth forecasts with its chief economist saying, quote, "We are entering a new era as the global economic system that has operated for the last 80 years is being reset." Pretty dramatic words. What do you think about that, and how does that reset what you do for a living?
Yeah, it is dramatic. It's a big statement. I think it makes sense. It's hard to find an economist out there who likes tariffs or who doesn't like free trade. It seems pretty consensus that tariffs and especially tariffs of this level are kind of anti-growth or anti-GDP growth. The administration in the U.S. has some non-economic goals, reindustrializing the U.S., bringing manufacturing jobs back. So they might not necessarily be concerned about that. From an investor's perspective, we just have to focus on quality, focus on management teams that can navigate these waters. There's still a profit motive, so companies are going to try and figure this out. They're going to move supply chains around, but it'll take a lot of time to settle out. And the uncertainty we see today is as high as it's been in at least since COVID, if not for decades.
This might be a little bit out of your purview as an investment advisor, but when you talk about reindustrializing the US, what does that look like to you? I mean, does that look like people going into factories making parts for air conditioners when we're in the age of AI? What do you think?
To me, it does not. I think that, if the incentives are laid out with tariff policy for US companies to bring manufacturing back, I think it's going to look a lot like autonomous robots and AI and high technology tools, as you mentioned. I mean, there will be jobs in those areas. We're seeing, even prior to these tariffs, a reindustrialization or an onshoring of some critical supply chains, things like semiconductors, biotech, and that makes a lot of sense. But those are high quality, high technical jobs that require a lot of expertise. So I think that if we're bringing back things like making t-shirts or making washing machines, it's going to look a lot different and it's going to be very robotics focused.
Well, you mentioned AI, so let's go back to stocks now. Is there still an AI trade?
In our view, there is still very much an AI trade. These names are volatile. AI is in its early days. So there's going to be big swings and big changes in estimates to what the use case looks like, adoption rates. But we still very much believe in this trade. There's been some evidence that AI adoption is tracking very well online with what you might have seen from personal computers or internet early in those stages. So the stocks are volatile. Certainly, the trade war and tariffs on chip exporters isn't helping. But I think that for investors who have a long-term time horizon, this is a great opportunity to get into some of these names, which until recently had been trading at nosebleed type of premiums. So I think the AI trade is still there, and I think it's a good opportunity for investors to add to those secular winners.
In this environment, what goes up, it seems like must come down with all the market volatility. Would you call this the anti-US trade?
Yeah, I think there's some evidence of that. I think the biggest evidence is in the dollar. We have this precipitous drop in the dollar below some key trend lines, at multi-year lows. I think it's probably on the margins. It might even be a bit overstated, but we're certainly seeing evidence that international investors, international central banks are at a minimum getting the message that they should probably diversify a little bit away from the dollar, just given the rhetoric of the administration. So I think that's showing up in gold. I think it's showing up in international outperformance. I don't know if it's anti-US, but there's certainly a lot of opportunity for asset classes outside of US stocks to do well in this kind of environment.